Hello, everybody, and welcome to our training today. Today, we're talking about venture capital. We're going to talk about how to actually use venture capital to get money for your business. So by the end of this training, you're going to understand how venture capital works, how venture capitalists work, and how this process can help you get money to either start a business or grow an already what looks like could be successful business. So we're going to dive in, a lot to cover. Let's get started. So first of all, for those that don't know me, my name is Ty Crandall, CEO at Credit Suite. And it's Credit Suite. This is what we do. We help business owners get capital. So if we can help you along the way getting money or building business credit for your business, get in touch with us. I'll put a link at the bottom of our slides to get approved for financing, creditsuite.com/get funding, and our phone number 877-600-2487. So let's dive in. Okay, so getting the working capital you need obviously is not the easiest thing, but doesn't have to be hard. A lot of different ways to get money for your business, and venture capital really is one of the very successful ways that you can get money for your business. So when I talk about getting money, really there's two different buckets or ways that you can get money. And Steve says, "What's up, Steve? Thanks for tuning in." So one of them is called debt financing. And debt financing is where we use loans. We use credit lines. We're basically having people give us money, we're acquiring debt, and then we pay that back at a set interest rate. Then there's what's called equity financing. And equity financing is where we don't have to pay that money back like we do a loan or a credit line. Instead, what we're doing is we are giving away equity in our business or some form of ownership in our business in exchange for the money. So two very different kinds of financing. And today, you're going to really get a good idea on whether or not equity financing is for you, because angel investing and venture capital are the two best and biggest and most popular forms of equity financing. So when you're getting money for your business, do you get debt financing, or do you actually come in and do you do equity financing? There's a lot of different categories under each of those, but that's actually how venture capital works, is it's equity financing. Okay. So this is where, again, you're giving up equity in your business for ownership or for the money that you're looking for. So according to Investopedia, a venture capitalist is an investor who either provides capital to startup ventures or supports small companies that wish to expand but do not have access to equity markets. Venture capitalists are willing to invest in such companies because they can earn a massive return on their investment if these companies are successful. We're going to talk about that, because what's interesting about venture capital, what's interesting about equity financing, is it's the opposite of debt financing here. When you're getting money from lenders, then what they care about is risk. They're really conservative on the risk. They don't want to lend money to risky businesses, risky endeavors, risky individuals. Venture capital is exactly the opposite. They look for risky endeavors. They look for long shots. They look for big payoffs. And that means that they have to get into the risky space. So completely different areas. If you've got a low risk business, low risk investment, well, then you're going to go get debt financing. But if you're looking to shoot for the stars and you have something that could be groundbreaking and really make a difference in the world, then that's when you look at venture capital, because they want those shoot for the stars kind of ventures. Okay, so hey, and Daryl says, "Hey, Ty, hey, what's up, Daryl? Thanks for joining this from Facebook." Okay, so it gives you an idea about what venture capital is. Now, venture capitalists will give you money to build new startups if the VCs believe the company has both high growth and high risk potential. Like I said, kind of interesting when we talk about getting money and we talk about they want high risk, but those two go hand in hand. When we look at an Uber of the world, that has massive growth potential if it takes on, but it's also extremely high risk, because to build the infrastructure they need costs obviously hundreds of millions of dollars to do. So it's high growth potential, it's high risk. Same thing as Airbnb. All of these biggest of Facebook, the biggest of the privately owned, publicly owned companies that we've seen, they come from the same world, right? It's very high growth, really opportunity to absolutely be billion-dollar companies, unicorn companies. But the problem is they're high risk. It's a lot of money it takes to get there, and that money could all be lost in the quest to actually make it a success. So this tends to be very fast growth companies with an exit strategy already in place. Venture capitalists look at you for two unique things. They're looking for something that could grow really fast. They're looking to throw money or fuel on a fire, and they want to see this thing explode with growth. And they also want to know you have a plan for them to get their money back. The company gets acquired. You sell the company. You take the company public. They're really looking for you to have an exit plan in place. Now, they really want to preferably exit in 3 to 5 years in a lot of endeavors. Obviously, bigger endeavors like Uber, they know is going to take longer. But a lot of venture capitalists that are getting involved at a business at our level are going to be looking to get their money back in about 3 to 5 years. Now, this often will want to take a large piece of your company in exchange for the money. So let's talk about this. We're going to talk later about angel investors versus venture capital. Two of the main differences: angel investors tend to get interested a little bit earlier in your process. And today we'll talk about the different rounds of funding that you get when you raise money for your company and who gets involved in each round. Angel investors are in the very beginning stage. Venture capitalists, they might get involved before you have revenue, before you have profits, but typically they see that you have a model that is growing fast already or really has the potential to. Now, angel investors, very small stake in your business. They may want 1%, 2%, 10%, 20, 25% max. Venture capitalists, they may want a controlling stake in the business. So if we think about Shark Tank, there's a lot of times where they want 20, 30, 40, 50, 60%, even 100% ownership of the business. Venture capitalists are going to have to give a bigger stake, a bigger portion of ownership interest for them to really have an interest in your business. Now, people like Jeff Clavier do both, probably depending on the amount of risk and that expected amount of return, okay? And he's one of the most popular and well-known venture capitalists in the space because of his success in many endeavors. Now, so apart from him, some of the other most well-known venture capitalists include Jeremy Levine, also Pinterest's largest investor, early Facebook investor Jim Breyer, Twitter investor Peter Fenton, PayPal's co-founder Peter Thielen, okay? Chris Sacca, an early investor in both Twitter and Uber. We've seen Chris actually on Shark Tank as well. And these aren't the only ones. You know, a lot of people don't realize that people like Jeff Bezos, people like Elon Musk, these guys had big successes in their career. Then they came out and they used those funds to invest in other businesses that became gigantic, not just Amazon, not just their own, but they invested in places like PayPal and these other endeavors that made them even more money and to get to the point where they are now. Okay, so a lot going on. And Andre says, I appreciate the knowledge. Thanks, Andre, for tuning in. Morning, Flynn. Thanks for coming in and joining us today. And Romeo, thanks for mentioning Katrina here as well. Okay, so one path is a tech-oriented investment banking. So how do these guys become a venture capitalist? Well, the other more common method that people become venture capitalists is they're just serial entrepreneurs. When we look at people like Jeff Bezos, when we look at people like Elon Musk, these guys had very successful endeavors before they ever got to where they are now. People forget that. If you look back at the history of some of the most well-known CEOs and entrepreneurs, some of these guys had massive successes in other businesses. Then they invested in other businesses. That got them a rate of return. They became billionaires and then were able to use their billions to create these massive companies that they have now. So again, a lot of the people that are venture capitalists, they are entrepreneurs. They've built companies. They've sold companies. They've been through the process. And now they're looking to take their own knowledge and apply it to similar businesses and then have those businesses take off, or similar industries, I should say, as we'll learn a little bit later. So again, this is a person with a company. Some people will work as individuals. Some people will work with VC firms. So there's a couple different ways you're going to find venture capitalists out there. Now, this is fairly new. I mean, past World War II is where we really saw venture capital come around. Outside of that, you look at like the Vanderbilts, you look at the Rockefellers. I mean, there was just a few families that controlled almost all the wealth in the country. And those were the ones that would back these other business endeavors. Then after World War II, we started to see venture capitalist firms created. We started to see more venture capital, more private money come into the space to invest in businesses like yours and ours. Okay, a lot of it, I'm not going to go through a lot of the history here, but you can see the Fairchild Semiconductor was the first startup backed with venture capital. I don't know. I like history. I'm a history buff, so I have to include some of that. Okay, they were actually founded in 1957 and funded 2 years later. And at the time, VCs would set up limited partnerships to hold investments. So a little bit different, but I think it's kind of interesting to see the first official venture capital investment that's actually out there. And there it was, the Fairchild Semiconductor. But again, not really applicable because I know you want to know how this works for you. So not a history buff like me, that's okay. Okay, so venture capitalists look for a strong management team. So we're going to talk a little bit later about what you should have in a pitch deck for angel investors and for venture capitalists. But one of the things they want to see is a strong management team. They want to see a good board of directors. They want to see a good board of advisors. And don't be surprised if they want to be on your board of directors. They want to recommend people be on your board of directors as well. They're looking for a massive, large potential market. So let me give you an example. I know some people that originally passed on Yeti, like Yeti coolers, Yeti Yeti mugs, the insulation that keeps these things super cold, right? And they did so because when Yeti first pitched, they pitched to a very limited small market of outdoorsmen. I'm not saying outdoorsmen is a really small market, but it is in the scope of things. So they lost a lot of venture capital, and the feedback they got was, your market's not big enough. Then Yeti came out with products that work for everybody, right? I don't know about you. I'm not an outdoorsman myself, but I have Yeti mugs. I have Yeti coolers. So they expanded their product line outside of outdoorsmen, and that's how they got the potential capital they needed to become the, I don't know, maybe billion-dollar business that they are. It came because they had started with a very small market, but they expanded it because venture capitalists requested that they do, to actually get as popular they are. Another one's Top Golf. Top Golf was actually founded overseas. And when Top Golf was actually founded, there was no food. It was just basically a driving range where you could have a chip put in a ball that could then give you all kinds of data on that actual ball and where the ball went, how fast the ball went, right? So then venture capitalists got involved, and venture capitalists said, this is going to be too small of a market. You're only going to appeal to golfers. We want to appeal to everybody. We want to appeal to the masses. So venture capitalists made it multi-tier. Venture capitalists made it a game with the actual chip and all these games you could play. They brought in the food. They brought in the beverages. They brought in all the things that took Top Golf to what we know it to be today, an entertainment mecca that like appeals to people like me that is not even an avid golfer. So venture capitalists are looking for a large potential market, or looking for a product like Yeti or Top Golf where they can make it form, they can make some changes in and make it have mass market appeal. So they really want you to have a lot of people you can appeal to, not a small niche, okay? Jessica from YouTube says, how do you find an industry-specific VC and or angel investor? We'll talk a little bit about that, but the best way to do it is to just Google. Google gives you the best information when it comes to finding an industry-specific venture capitalist. Another great way to do it, just so you know, Jessica, is to work with angel investors. Angel investors have the best amount of contacts to venture capitalists because they invest initially in a business, and when those businesses take off, they want their venture capitalists to get involved to pour more money in to make it even more of a success. They're also looking for a unique product or service. Very difficult to get venture capitals involved unless you have a very unique competitive advantage. They really want to know who your competition is. They want to invest in somebody that has little to no competition or has a huge advantage over competition. So again, if we look at things like Uber, there was no competition when they really got into the space. Lyft and Uber started about the same time, but not a lot of competition there. When we look at Airbnb, not a lot of competition unless you consider the hotels to be their direct competitor. The space they got into was unlimited. It was massive that they could span all across the world, and they didn't really have anybody they were competing with. That's what really kind of unique product or service venture capitalists are looking for. Or, as I mentioned, a strong competitive advantage. So they want to see if you do have competition, that you at least have a huge competitive advantage against those competitors that are actually in your space now. So what are these guys looking for? Well, first of all, venture capitalists, as Jessica pointed out, they want to actually be in industries that they have some familiarity to, okay? They don't want to go get into an industry that they know nothing about. We see this on Shark Tank all the time, where sharks will bow out because they're like, I have no knowledge and I have no interest in your space. So like, I'm out. I'm not going to provide value here. Venture capitalists want to be passionate about what they're investing in, and they want to be able to contribute value. And a lot of times they can't contribute value if it's in an industry they don't yet know, or understand. So they're typically going to be in industries that they have some kind of experience and familiarity to. And they also, again, want to own a large percentage of the company so they can influence its direction. As I mentioned, they're also going to want to put people on your board of directors because they're going to want to control the decisions of the company. A lot of angel investors, not so much. They're deploying money across a lot of different places, hoping it pans out. But venture capitalists, they're investing their money in a smaller amount of companies, and they want to have more control to control the directions and the success of those companies. Not to mention that they're investing oftentimes millions, if not tens of millions of dollars. So what are the downsides here? Well, venture capitalists can experience significant losses if their picks fail. It's high risk, it's high reward. Okay, and that's what they're looking for. Opposite of banks, opposite of credit issuers. They know they're investing in very risky businesses, and they are hoping for a massive payoff, but it can ultimately end in bigger failure. They have bigger failures than angel investors because, again, they're going for pie in the sky dreams, shooting for the stars type companies. So because of that, a lot of them fail. And then only a few of them succeed, but the few that succeed could be billion-dollar companies, which is why these guys do it, okay? Because they're typically wealthy, though. And the reality is they can afford to take these risks. What happens with venture capital is that even with all of their losses, they still make more money on their wins than they do investing in places like real estate or the stock market. And this is the way that it is. This is why peer-to-peer lending has become so popular, where people like you and I can invest our money into privately owned companies, because the reality is, all the statistics show that's sometimes a better investment than investing in the stock market and investing into real estate. You're going to get better returns even when you calculate your limited wins and your significant potential losses. And Jessica says, my competition is minimal. It's a 1 to 2 hour drive away. That's perfect. But again, we're talking about worldwide. Don't forget that. When we're talking about this, they want something that can spread across the country, spread across the world. And they're looking at competition and everybody out there that can be competition, just so you know. So something to keep in mind. So as long as they seem to have a great idea and great management team, these are the main things. They really care about this. Now, again, we see this on Shark Tank, right? We see people that say, look, your business is okay, but you're awesome, and I'm going to invest in you. Because that's the way venture capitalists are. If they see a very powerful, smart, humble CEO that could do amazing things, they want to invest in that. So they're investing in a great concept, but they're also investing in the leaders that they know can take that concept and make it something super, super, super successful. So it really works both ways. So these firms are put together by pooling money together. They get money from the venture capital firm itself, wealthy people, hedge funds, pension funds, foundations, insurance carriers, corporate pension funds. All of these places are looking for a way to get rates of returns for the people that are investing in them, whether it be hedge funds or pension funds. So they pool together the money from these people, and then that is the money that is actually lent out to businesses. So who controls them? Well, there are partners that have part ownership. However, the VC firm controls where the fund is actually invested, not the actual partners. And investments are usually into businesses or ventures, which most banks or capital markets would consider too risky. That's what we talked about. It's the opposite of banks. Banks won't go really high risk. They'll be like, whoa, it's too much risk. Even middle of the road risk, they pull back. Venture capitalists want high risk, which is what makes them unique. And the venture capital serves as the general partner. Insurance companies, pensions funds, those are all limited partners. So a lot of the people that invest in the venture capital fund are limited partners. And then there are actual controlling partners that control the actual venture company under or that are above the actual limited investors that are coming in that are actually putting the money in. So venture capital fund managers are paid with management fees and carried interest. Depending on the VC firm, about 20% of the profits go to the company managing the private equity fund. That's what goes to the actual company that's doing the investing, and then the rest actually gets passed through to the investors actually who are putting the money in to the actual venture capital fund that gets invested. So who works for these guys? Well, there's usually 3 positions: associates, principals, and partners. Here's why you need to know this. Because, I've learned, let me tell you, our path at Credit Suite, we were never contacted by venture capitalists. Then we got on the Inc. 5000, and this is a good lesson for you, for everybody watching. We actually applied and got onto Entrepreneur's most entrepreneurial company of the year in 2018. There's a lot of different places out there you can apply for. Best place to work, Inc. 5000. Again, best entrepreneurial company with Entrepreneur Magazine. If you look at these, there's all kinds of Inc., Forbes, Entrepreneur. They have all these different contests per se. Not a contest is a bad word, but these different, I don't even know how to actually the word for it, but these things like the Inc. 5000 that you can apply for. Now, keep in mind, okay, we got on the Inc. 5000 because we applied. We sent all our financial data in. There's plenty of people that never make it to the Inc. 5000, not because they can't be on there, because they never send their financial data in. So you have to find these kind of things like best places to work, like most entrepreneurial companies, like Inc. 5000. When you find them and you apply and you get accepted, these are the hit lists that venture capitalists use, okay? So once you're on those hit lists, everybody starts contacting you and wanting to give you money. It's kind of crazy. So for example, just yesterday, I'm conversing with somebody from Morgan Stanley about investing, right? They're meeting with us about that. And it all comes from being on the Inc. 5000. So when you're contacted, when you do that, I just kind of give you a big tip. If you want to be found, be found. Get on some of those lists. Those lists are where these guys are going to get their leads. Then you're contacted by an associate. Know who you're dealing with and ask them their role. Are they a principal? Are they a partner? Are they associate? That's important. Associates are the bottom feeders. They're the ones that just go out and massively hit everybody on the Inc. 5000 with the same standard email templated message. And then you respond, and then you meet with either them or a principal or a partner. But when you first meet with a venture capitalist, ask them who they are. What is their role? You need to know, are they the associate and the bottom feeder that's kind of going through and finding the leads to move up to principals and partners? Or are you really meeting with a principal and partner? And in most cases, it's an associate that you're actually dealing with. So it's the associate that you're dealing with, not a principal and partner, but it's important to know those roles and know who you're actually dealing with. Now, associates usually have some experience in business consulting and finance. They sometimes have a degree in business. They offer the more analytical work. They analyze business models, industry trends. They also work with companies in the firm's portfolio. They start off as like junior associates and basically work their way up. That's most of the people on the front lines you're going to deal with. A principal serves as like a mid-level professional. They generally serve on the board of portfolio companies. They're often in charge of making sure the companies, the venture capitalist portfolio are operating smoothly. So like I said, when the venture capitalist firm wants to put somebody on your board, that's these people. That's their principals that are their mid-level kind of management. And they're in charge of identifying investment opportunities for the firm as well. So it might be the principal that you're dealing with versus who we just talked about here of actually being the associate. That's why you need to ask to know who you're actually talking with when you speak with a venture capitalist. Principals can become partners. That depends on the returns that they actually generate. And partners are mainly focused on identifying areas or specific businesses for investment. So they're saying, hey, look, go target this industry. And then the associates will go gather data of all the people to target, for example, in that industry. So it kind of gives you an idea of the roles of each of these people in these VC firms that you're going to deal with. So here's the funding stages. You hear a lot about this, but a lot of people don't usually break this down. Okay. And venture capitalist comes in these stages, not all at once. There's 6 stages you need to know about. They are more or less correspondent to the stages of a company's development. Like depending on how how a company grows, they are basically coming in and doing development based on how that company is actually growing. So let's look at seed, startup, growth, Series A, growth round, Series B, expansion, or bridge. Those are the main 6. I'm going to break them all down, but these are the main 6 types of, or 6 stages of capital investments you can get from equity investment, whether it be angel, whether it be venture capital. Those are the 6 stages. So seed funding is the earliest round of financing needed to prove a new idea. Funding often comes from angel investors, or lately equity crowdfunding. So remember, I said we'll talk later about angel investors versus venture capital. Angel investors, as I mentioned, get involved early in a business. They get involved typically when you don't have a product yet, when you might not even have a service, when you don't have any customers. They're like in the very, very, very beginning stage, almost always before you're even generating revenue. Angel investors are involved in this seed round. Then we get to startup, early stage firms which need funding for their expenses from marketing, product development. Now you have an idea. Your idea is getting off the ground. Now you need money to market the idea. You need money to develop the product. That's what's called a startup stage, also a common place where angel investors typically invest. Now we get into growth, or Series A round. And this is early sales and manufacturing. This is where your product is developed. Your company structure is built. You're starting to make sales. Not profitable yet, but you're starting to make sales. Okay. This is where venture capitalists come into the picture. So Series A is essentially the first institutional round, as it's called. Here's where most companies will have the most growth. So angel investors, these guys will invest small amounts of money, $5,000, $10,000, $15,000, $25,000. They don't want a seat at the table. They don't want to be on your board of directors. They don't want a huge ownership interest in your business. They get involved in seed and startup rounds. Then venture capitalists who want more control, want a bigger ownership stake, want to sit on your board of directors, they start to get involved right here in this growth period, or seed A round. Series A round is where venture capitalists get involved. Now, the second round, this is where we call the Series B. This is working capital for early stage company, which are selling products, but not yet profitable. Then we get into expansion, or AKA mezzanine financing. It's expansion money for a newly profitable business. So now we're in second round funding. We're not profitable yet. Then we're profitable. Then we get into expansion funding. Then we get into bridge financing, which is our startup seeking funding between these rounds. So bridge financing bridges the gap between these rounds. So you might be going between second round and expansion. You're not profitable yet, but you ran out of money from the venture capitalist and you need more. And then that's when we come in here and we actually get into bridge financing as well. So this is where you're able to come in and actually get money to bridge the two rounds. VCs usually leave via a secondary sale and IPO acquisition. Like I said, they want you to have an actual exit plan. So as I mentioned, angel investors, venture capitalists, angel investors, not the same. They typically get involved earlier. They usually want a smaller interest. They typically invest less, and they don't want a seat at the table. They don't want to be, for example, on your board of directors. So that gives you an idea. Now we understand how the rounds of funding, we understand who venture capitalists are, we understand what venture capitalists do, all those kind of things. So let's talk about your pitch deck, because if you're going to pitch to venture capitalists, if you're going to pitch to angel investors, you're going to need to have a pitch deck, okay? So here's the kind of things that you're going to put in your actual pitch deck. An overview of your company, who your company is, what you're all about. You're going to want to have a mission statement or the vision. Who do you serve? What are you trying to accomplish? What's your vision for the actual business? Your people, again, they're very interested in the management team. Who's in your management team? But also, if you have a large staff, etc., if you have well-known people on your staff, you want to highlight all those, okay? So, for example, Credit Suite, we've only had one person ever quit our company since inception of our company. We've had hundreds of people work here. We've had to let people go because they didn't perform, but only one's ever quit. That's something we mention in our pitch deck because that's something big. It's reflective of our culture and our people, okay? You also want to really highlight the expertise of your management. Your needs, okay, what it is that you actually need to be able to perform your vision, the problem you solve and how you solve it. What is the problem in the world you're trying to solve? In our world, it's a matter that business owners struggle to get capital. That's the problem that we're really looking to solve, okay? And then how do you solve it? What's your format? How is it that you solve that problem? The market you serve, how big is the market you serve? Again, they want to go to a mass market. So they want to know how many people you could potentially serve. What your competition is. Again, they're trying to see, do you have competitors? And who are those competitors and why are you different? If you've ever watched Shark Tank, which almost all of us have, then you see that they don't like it when you say you don't have competition. Almost everybody has some competition. So you want to acknowledge that you have competition and why you're different. Your past numbers, your financial numbers, what kind of revenues, what kind of profits have you produced, prior success, your business model. How is your business set up and structured? How do you make money? How does that work? So when we constructed Credit Suite's pitch deck, for example, then we look at, hey, we make money from funding. We make money by selling business credit. We make money from our partner program. We have these subscription recurring revenue. So you're going to want to break all of that down when we talk about your business model. Financial review. Let's look at your financials. What was your revenue the last years? What was your profit the last years? You need to know your numbers. Okay, and you need to have projected numbers, and those could be based on anything you think that projections should be based on. When we do our projections for our pitch deck, we look back at our historical growth, average out how much we grow year to year, and then we base our future projections on that. So it's easy for us to sit in front of an investor and say, these aren't just pie in the sky numbers. We're giving you our projections based on what we've already done in the past, for example. And you're asked, what is it you're looking for? What is it money-wise you're looking for? Now, one of my buddies, Mike Weiss, Mike, W-E-I-S-S, brilliant guy. And what Mike does is Mike helps companies provide better education to their audience. So for example, he's helping Credit Suite come in and improve our customer experience so more of our clients get their goal of getting to the end of the process, building their business credit. And Mike taught me an amazing way to do this, which is to actually put together a pitch video. So in his world, you come in, you sign a non-disclosure agreement electronically, which means that that person that's watching it can't disclose the information they get. And you go to a 30-minute pitch video from Mike. And what Mike does is he's talking to the camera just like you and I are now. And then he goes in and he edits in the shots from his pitch deck as well as him being on camera. So it's a great way to do it. Nowadays, this is awesome. In 30 minutes, he doesn't even have to meet with an investor to pitch him. What he does is he puts the whole pitch on video, a combination of him looking at the camera like this and him using a pitch deck with that kind of edited into his video. And then somebody signs a non-disclosure, they go in and watch his video. And then if they want, they can schedule time to talk to him more. So this is a brilliant way to do it. Create a mini funnel for potential investors. So instead of trying to pitch each one of them or get in front of them to pitch, you just send them to your video. Let your video do the pitch. Then if they want to know more, they could do more, and you could do a deeper dive with them. So a lot of ways you could do it. Having a pitch deck, once that's created, it's not all about now waiting for that pitch deck to go to pitch to somebody. Create a video, create a mini funnel, non-disclosure agreement. They come in. They actually see your pitch video. They can schedule a consultation to learn more. It's a great way to put all this information in front of these investors that they want to see without actually taking the time to meet with them, and then having them only get with you if it makes sense. Let me tell you why this is important. I talk to a lot of venture capitalists now because, like I said, being on the Inc. 5,000 stars, we start to get out there and get more press. More of them are actually knocking on our door. And I can tell you they're all looking for completely different things. Some are looking for EBITDA. They want to know what your profit margins are now. Others are looking at your growth rate. They want to see how fast you're actually growing. Okay, they all look for something different. So that being said, you know, it's easy to do a video like this and have them all go there to even see if you're a good fit before you spend the time to meet with them one-on-one. Although, you know, it makes you feel good. When you first start to get solicited by these guys, then it makes you feel good. You kind of want to meet with them, but then you quickly realize that a lot of them are going to approach you. And that's where like a video type of format can actually help you. Okay, so venture capitalist, fairly new after World War II of way of investing. A VC invests in startups, but a lot of angel investors invest in the first 2 rounds of getting a business off the ground. Then venture capitalists really get involved as you start to make sales and before you're typically profitable. They're looking for companies and industries that they know and they're familiar with. They're looking for more amenable to higher risk. They want high risk, high reward investments. And usually they invest more money than angels do, but they want a bigger ownership stake. And funding comes in well-defined stages. We talked about the 6 stages as well. And they're going to want a piece of the business, a pretty big piece. They're also probably going to want a seat on your board of directors as well. So if you go to youtube.com/credit suite, you can get our training on pitch deck. I think I've got an older training on that. And I will soon do another updated presentation on how to really build a pitch deck for angel investors and venture capitalists. I touched upon it, 2 slides. Here's what you want on there. But I want to actually really go through and break down what's on a pitch deck. So I'll do that in future streams. And if we can help you get money for your business, feel free to reach out to us, 877-600-2487, info@creditsuite.com. Also, at the top right of our page, creditsuite.com, you can get all of our social channels. We actually go live on Periscope, YouTube, and Facebook 3 times a week now, Tuesday and Thursday at 1 Eastern and 11 o'clock Eastern on Wednesday. And then we also have daily tips on Instagram, Twitter, and our podcast where you can listen on your go. You can access all of that at creditsuite.com. So thanks for tuning in. And Steve likes the idea of a pitch deck. Great. I'm glad you like that. I'm going to go through and break that out. I got to be honest. I used our own training to create our own pitch deck. So that being said, it's something that I think a lot of you can get a lot of value from. Steve says you're on a roll. Great info. Great job. Thanks, man. I appreciate it. And everybody, don't forget to like and share. If you got value from this, go ahead. Give me a like. Give me a share. Subscribe. Okay, that's all I ask. I try to pour my heart into giving to you guys as much value as I can, creating the content. All I ask is give me a like and a subscribe. And what that does is allows more people to actually see this information and be able to get value to help their business. So by helping me, you're kind of helping everybody else. And I appreciate it. All right. Thanks, everybody. I'm going to wrap up. I will see you next Tuesday live on YouTube, Facebook, and Periscope at 1 o'clock Eastern. Thanks, everybody. Have a great day.